The Federal Reserve is making a mistake about inflation. I'm Dr. Bill Connerly. I connect the dots between the economy and business. And I'm going to address this topic from a business leader's perspective. If you are running a business and thinking about the second half of 2021 and what 2022 will look like, and even 2023 and beyond, you should understand the chance that they are making a significant mistake at the Federal Reserve. Now, the folks at the Federal Reserve are smart, they're well intentioned, well educated, but I believe they're making a mistake. Before getting into the mistakes, let me talk about the driving factor of inflation. The Fed has noted that there are some temporary factors, and I absolutely agree. Car prices are high because of the computer chip shortage. We'll work through that. Building materials prices are high because of the shift to single-family home starts, because of cheap mortgage rates. That's probably temporary for a couple of years. But I believe we're going to have significant inflation. So the Keynesians talk about federal government spending as stimulus, and we had a lot of stimulus in 2022, but the stimulus is continuing in 2021. And did I say 2022? I meant 2020. And the stimulus is continuing into 2021 big time. In addition to the federal deficit stimulus, the Federal Reserve is putting a lot of stimulus into the economy, and that big jump happened last year, but now it is continuing with the Federal Reserve printing money virtually to buy bonds and mortgage-backed securities. With all of that, I think that the Federal Reserve is making a mistake. Let's talk about the mistakes that I think they're making. And the first one is forgetting about time lags. When the Federal Reserve takes action, they do not see an immediate effect. Yeah, interest rates may change immediately in stock market prices, but the effect on the real side of the economy, spending, production, employment, takes about a year. Now, it's not all of a sudden it happens, it's a distributed time lag over time, but about a year as a rough rule of thumb for action to affect spending, production, and employment. But that's not inflation. The inflationary changes are more like 2 to 3 years away. And with those time lags, the Federal Reserve should be following the advice of the great hockey player who said, I don't skate to where the puck is, I skate to where the puck is going to be. So the Fed's second mistake is running the economy hot. That is, trying to keep the unemployment rate very, very low, like it had been in, say, January 2020, just before the pandemic landed on the shores of the United States. At that time, it was the easiest era ever to find a job if you were a high school dropout with a prison record. Now, there weren't many employers looking for high school dropouts with prison records. They were looking for people who could do a basic job, and all they could find were the dropouts with prison records. Well, if you are woke, as the Federal Reserve now is, you say running the economy hot makes sense if we want to help the most disadvantaged people in our society. And that is true, but it ignores the risk of inflation and great destabilization of the overall economy. So let's go to their third mistake. They're forgetting the time lags, they're running the economy hot, and I think that will mean a slow response. The Federal Reserve has said that they are not going to try to anticipate inflation. And to be honest with you, forecasting models of inflation, both at the Fed and at independent economists like myself, our forecasts of inflation have not been very good. So the Federal Reserve is just tossing out the idea that they can forecast inflation. They're going to get inflation to their target of 2%, and then they want to run it above target because they've been below target, so they want to average higher and lower, and then they will start to do something. But remember those time lags. If you're running the economy hot and you're going to be slow to respond when there is a clamor about inflation, And I think in 2022, next year, we will see a significant public outcry about rising prices. The Fed will have to tap the brakes of the economy, so to speak. They will tap the brakes, but because of those long time lags, nothing will happen. Nothing will happen. The Fed taps the brakes once, nothing happens. Taps the brakes a second time, nothing happens. Taps the brakes a third time, and the outcry about inflation may be so strong that the Republicans gain control of the House and the Senate in the 2022 elections. That would be a wake-up call for the Federal Reserve. And then at some point, I'm not sure exactly when, but at some point the Federal Reserve is going to stop tapping the brakes and slam down hard on the brake pedal. The American economy will go into a recession, and then the Federal Reserve will say, holy cow, we need to hit the gas. And my first cab ride in Boston, the cab driver always had his foot pressed all the way down on the pedal. Sometimes it was the brake pedal, sometimes it was the gas pedal, but the foot was always straight down on the pedal. I think that is the Federal Reserve in the early 2020s. So, from a business standpoint, I would suggest that business leaders think about sustained inflation coming, and then a more cyclical economy. I wrote a book a couple of years ago called The Flexible Stance, Thriving in a Boom-Bust Economy. I think that is going to be the hot seller in the economy of the early 2020s, with recessions followed by booms, followed by another recession. I'm Dr. Bill Connerly. Thanks for watching this. If you like what you hear, I put out a monthly newsletter. It's free. It has charts on the economy with my handwritten comments. You can receive that newsletter by texting the word econ to 42828. Just enter that number like a phone number, 42828. Text the word econ and you'll get my newsletter. You can also subscribe to my YouTube channel. Thanks for watching.